Are you looking to become a better real estate investor? Then hang on, because you're about to experience another episode of the world's most popular real estate podcast, the BiggerPockets Podcast. But before we get to this week's show, I wanted to invite you to become part of our community, BiggerPockets.com, the real estate investing social network. The membership is free, and you'll instantly gain access to networking opportunities, educational content, investor tools, and more. Sign up now and get a free copy of our book, The Ultimate Beginner's Guide to Real Estate Investing, read by hundreds of thousands of budding entrepreneurs. Just click this link right here or just head to BiggerPockets.com. With that, let's get to the show.
This is the BiggerPockets Podcast, show 135.
And then in 2014, I bought a 209-unit deal for $6 million that appraised at $7.4 million on day of purchase. And when we're recording this in 2015, I'm actively looking for 100 to 400-unit deals up to a $15 million purchase price.
You're listening to BiggerPockets Radio, simplifying real estate for investors large and small. If you're here looking to learn about real estate investing without all the hype, you're in the right place. Stay tuned and be sure to join the millions of others who have benefited from BiggerPockets.com, your home for real estate investing online.
What's going on, everybody? This is Josh Dorkin, host of the BiggerPockets Podcast, here with my co-host, Mr. Brandon Turner. What's going on, sir?
Guess where I'm going next week, Josh?
I know where you're going next week.
Oh, well, everybody else, guess where I'm going next week. And
I'm going to Disneyland.
I'm going to Disneyland. Woo. Yeah, I'm taking a 4-day trip to Disneyland.
4 days to Disneyland.
4 days at Disneyland.
That's a bit much, I think.
Well, I've only spent 2 days there, and I'll spend 2 days visiting some friends and such down in the Southern California area. So,
excellent.
But I'll be back before this show airs, so don't come to my house and break in because I'll be here naked.
Nice. That's just disturbing. That's disturbing, my friend. Well, can we just
let's go
forward?
on? Let's go on. Today we have
like a really bad picture in my mind here. But yeah, so we do have a great show today, and I'm super excited about it. We'll get there in a second. Let me tease it. This guy is amazing. This guy is doing some really cool deals. And the cool part about it is, he's so open about how he actually puts these deals together. And so you definitely want to catch us. Again, whether you're a novice or you've been in the game for 10, 20 years, there's great insight here. So let's get to today's quick tip. Today's quick tip is we are currently kind of facing some weird thing on iTunes. So if you're going to iTunes and you want to check out our shows, you could only see the last 20. We've been told this is a bug, but we do not know. So it may happen forever. And so if you want to see shows past the 20 current shows, go to BiggerPockets.com/podcast. That's BiggerPockets.com/podcast. And you can find all of our shows. You can see all of our show notes. You can listen. If you can't see them on iTunes, that's what you want to do. You could also actually listen on SoundCloud or Stitcher. So there's alternatives as well. So definitely go ahead and do that. With that, why don't we bring in today's sponsor?
B2R Finance is a new commercial lender offering loans specifically for rental investors. B2R Finance can help you unlock equity from existing properties so you can get cash out now. Cash out refinancing allows you to leverage your current investments to help you grow your existing portfolio. B2R is an asset-based lender, which means your loan is based on your property's appraised value and cash flow, not your personal debt to income. And that is huge. It opens up a lot of opportunities previously not available to rental investors. So you need a loan, call B2R Finance at 855-910-0227 or visit b2rfinance.com today.
All right. Thank you to that sponsor for this week. And let's get on before we get to the interview with Brian. I want to read today's one review from iTunes because I love this. This is from Victorian Junkie, which is an awesome name too. This podcast has been extremely influential in helping our business expand and learn about the pitfalls that can occur without the proper knowledge that BiggerPockets gives. I love that. That is from, again, Victoria Junkie, 5-star review in iTunes. So anyway, thank you very much for that review. You guys rock. And anybody else who leaves one, a rating, review, or subscribes to us in iTunes, it definitely helps us out. So we'll thank you guys in advance for that.
Excellent. Fabulous. Well, let's get to the show. Today we've got Bryan Adams. And no, it is not the guy who's going to serenade you. Not him. All right, we got Bryan Adams. Bryan Adams is a active real estate investor buying hundreds and hundreds of rental property units at a time with these large multifamilies. And he's going to talk to us today about how he does it. How does he raise the money? How does he put the deals together? What does it look like? Who can do this? Can you do it? I've been investing for 3 years, 5 years. Can I do deals like this? You're going to learn all that if you listen to the show. Lots of tips. And again, there's tips for everybody. So pay attention, tune in, and get your pencils out because there's definitely some notes to be taken. With that, let's bring on Mr. Bryan Adams. All right, Bryan, welcome to the show, man. It's good to have you here.
Thank you so much. Really appreciate it.
Awesome. So you and I started talking back a few months ago because you emailed me and just asked me kind of what my experience was. I was doing a webinar, and so we started talking back and forth with that. And I found out you've done a ton of stuff, and so I I had to get you on the show because, you're crushing it with your investing business. So we're gonna get into that today.
What does that mean? I'm not. You're a little more prepared than I am.
Of course,
Brandon.
I'm more prepared. You're gonna find out what it means. You're just a listener, Josh. I'm the host today.
You're something.
I'm something. All right. So let's start at the very beginning. How did you get started with real estate? Like, when did that happen? What was your first deal?
Sure. Well, it actually started at a very young age. My grandfather had some rental properties, and as a young boy, I would, mow his grass. He'd give me a couple bucks and, pick up the trash. And what was really cool for me to see at a very young age is he would take me along to go collect rent. And back then, my grandfather accepted all cash. I don't do that from a policy perspective, but, he was accepting cash. And then he would throw me $2, $3, $4, $5. So I got to see this exchange of money happening from a rental perspective. But then let's fast forward a little bit. So when I was a junior in high school, my football coach was also my accounting teacher. And he pulled me aside and said, Bryan, you're not the fastest guy on my team or the smartest kid in my classroom. I probably should have taken that as an insult at the time.
Yeah, wow. That's great. Thanks, Teach.
Thanks, Teach. But he said, you have this knack for accounting. So my junior year in high school, I knew I wanted to be an accountant. My buddies are thinking they want to be doctors, attorneys, Hollywood stars, whatever. But I was very focused when I graduated high school that I wanted to go get my accounting degree in college. And then once I was in college, I wanted to get my CPA license. So out of college, I graduated. And through this period of time when I was working with this high net worth groups, anywhere between $5 million to $100 million of people who were creating their wealth through real estate. So it all kind of came back to me that I remember the times with my grandfather, and I was working with all these clients from a real estate tax perspective to say, how can I help them create more wealth? And I just saw all the pieces kind of being put together for me. So back in 2000, I kind of, was doing the CPA stuff, but also I just bought a rental property, just one that I bought and started renting. And then in 2008, I'll never forget the time period. Again, my background is a CPA, working crazy hours during tax season, working on this very successful client. And he was just crushing it. He was just making all this cash flow, all this passive income. And I said, what the heck is this guy doing right? He's living the lifestyle that I wanted to be living, traveling, golfing, whatever. I was intrigued. So I started grabbing all his tax returns and realized that he had all these partnerships set up. All these partnerships were single-purpose business entities that were apartment buildings. Then he had a management company, a construction company. He had this whole business model. And imagine the spotlight shining down above and angels singing like, aha, I was like, oh my gosh, if this guy can do it, I know I can do it. So I kind of giving a long-winded answer of how I got started. But in 2008, I said, okay, I got to make some stuff happen. So I quickly went out, got some education, learned that the multifamily is where I wanted to go with my real estate investing career. Found a duplex. That duplex had a vacancy. And filled that vacancy. I was like, wow, this works on a very small scale. I can, create this passive income. So then I went and I know where we're going to get ahead in questions you're going to ask me, but then I went to really scale the business and focusing on larger apartments.
That's awesome. Okay. Yeah. I want to step back. Obviously that's the kind of focus of today's show, but I want to touch on a couple things. First of all, I thought it was cool the way that you mentioned that your grandpa used to let you come and pick up rent with them, right? So, yeah. I mean, I don't have kids yet, but for the people out there listening that have kids, and if you have a rental property or two or three, I think that's awesome to the more you can bring your kids into your business to let them just see the real life, fruits of your labor or whatever, like how that actually works, no matter what business I guess you're in, but especially real estate. I think that's awesome. I think that's just a great tip right there in general. But so what happened between 2000 and 2008? Did you buy others, like you bought a single family in 2000? What else happened in that time?
Well, really it was just, buying a single here, doing a rehab. There was no focus. There was no clarity. I knew I had a passion for real estate, but I was a pretty doggone good CPA as well, and that's what was bringing in the income. But, I think we all, operate from either a level of pain or pleasure. And for me to kind of kickstart my thing, as I mentioned, I have two girls, and during tax season, I was seeing them 10 minutes in the morning, plus my wife. And I was just operating from a level of pain, and I needed to make massive action and, take control of where I wanted to go with my life and things.
Nice. All right. So you're determined. You say 2008. I'm gonna change the way I'm doing things. So you go, you buy this duplex, and then you talk about kind of scaling. Well, how did that go? So what came after the duplex, and what was kind of the thought process that beyond like, hey, I want to own a bunch of properties. You had to have mapped out a plan. So let's talk about the plan, and then let's talk about the implementation.
Sure thing. So I'll give you the high level. I'm going to come back to some detail as well. So 2008, I got this duplex. I was like, okay, I know this can work. I did it at a very small scale. 2009, I tried to buy a 132 unit deal in Dallas, Texas.
Just a little jump there.
Yeah, just a little. But I knew, I knew my clients could do it. And reading in between the lines, I knew with a lot of focus, massive action, right education. And education's great. The books are fine, but you got to get out there. You got to get swings in the cage, and you got to take risk. And so in 2009, the 132 unit deal did not work out. The seller and I could not agree on terms. So we, that deal unfortunately folded. So, and I was trying to do the deal myself, trying to be the sponsor, trying to be the guy raising all the money. I realized there's multiple ways to get into real estate. There's multiple ways to skin the cat, so to speak. So in 2010, I partnered with a group. They found a 276 unit deal in Tennessee. It was a bank REO. We bought that asset for $4.5 million, and it appraised at $12 million on the day of purchase. Whoa. What I was able to do was add value. I was able to bring capital to the deal. It wasn't my deal. They found it. They were the sponsor. But what that has helped me now, looking back, is we were able to refinance that asset within a year's period. So I was able to get a nice return for myself, nice return for my investors. It's a great story. It's a good track record. So, and then from 2010, I made some decisions to buy some bigger properties from thereafter. Hey,
Brian. So let's talk about that. 2010, you said you partnered with a group. You said it was 276 units?
Yeah, that's correct, yes.
You guys paid $4.5 million, and it appraised at 12. All right. Yes. So what is the process of partnering with a, quote, group to acquire a $4.5 million property when you've done a duplex and maybe a couple singles and a couple other little things before? How does a guy, no offense, who doesn't know squat, all of a sudden get together with this, quote, group to acquire a $4.5 million property? I know that lots of people are sitting here listening like, oh my God, that's crazy. So please walk us through that process. What exactly did you do in this deal? Who were these people? How did you guys come together, and how'd the whole thing, flush out?
Sure. And it always comes back, guys, to relationships. It's everyone feels that, they're just going to go out and buy a property or a big property. But it always comes down to relationships and the people that you circle yourselves with. So, again, if those people are the negative ones, you're going to, unfortunately, be that negative guy. So I always realize that always going to be in the circles of those that are taking the necessary action steps, those that are, already burning the trail for me. Let's follow those that are smart. Let's follow those that have done this before. So to answer your question, I was just able to go through my network, go through my database, make outreaches to those that were, 10, 15 steps ahead of me and say, hey, this is what I can do for you. This is, I always want to add value to someone else's life. So if I can bring in my opportunity or my situation, I was able to bring capital. Some guys have, some people in your audience might be awesome, deal finders. They or others might be good networkers or relationship or someone that's a taskmaster, all about the details. So it's really looking at your strengths and saying, okay, here's my strengths. This is what I love to do. I like analyzing deals. I'm a CPA. Other people might hate that process. So if someone's able to find the deal or the money, we'll bring that to someone that skill set or their strength is there. And you just, play the strengths and weaknesses.
Okay, so you said you brought capital. I'm assuming that means, I'm assuming at this point, and maybe I'm wrong, that you didn't have the money for the down payment yourself. So bringing the capital means you went out and got the money, correct?
I got a portion of what we call private money or private equity for this opportunity. That is correct.
Okay, so can you kind of dig into detail a little bit more? I mean, I don't need the ins and outs of your contract, but what does that mean? I mean, how does somebody go and do what you did? Because I don't fully understand exactly what you're saying that you did.
Sure, no problem. So the asset we bought for $4.5 million, we got a bridge loan. So there was a portion that debt was in place of $3.2 million. So we had to raise capital of $1.3 million. Okay. So I was out of that 1.3. I didn't raise the whole amount at that time. I raised a portion of private capital. So I took this investment offering and presented to a group of my investors that we all would partner and share in not only the cash flows, but share in the upside of the project as well.
Okay. And did you bring any of your own money, or was it everybody, other people's money only?
In this situation, yes, I brought my own capital as well because I wanted to show my investors that I had some skin in the game. Some of my deals, though, I have not needed to bring capital just because then, track record gets established and trust and level of credibility.
Yeah. Okay. So a deal like this, you put a little bit of money in, I'm assuming you raised, the majority of the money. Again, it's an assumption. But what percentage of this whole deal do you end up getting?
Let's see, of the whole deal, I think I was maybe like 5 to 10%. No, I was a 5% owner, so it wasn't a significant amount. Yeah. But it was enough when you think of cash flow and back end profit. Yeah. And sometimes I'll be really clear on this one. Is I realized my experience in 2009 where I tried to do it all myself and I struck out. So sometimes that first deal, you got to take a couple steps back, realize, okay, this is the big plan. This is where I want to get to. Sometimes you may, take a lot less. Something is better than nothing. So that's what I looked at. I said, okay, I'm just going to take a small piece of this, and then let's see where this goes thereafter.
Yeah, it's great. And you get a piece of this deal that I think a lot of people hear like, oh, well, I got 50% of the deal, and you should always go there. And I don't think I've heard on all of our shows and all of our interviews, I don't think we've talked to a person who's said that they've taken anything less. Now, granted, they're working on different proportions here. They're working on 3 units and 2 units and 5 units, and so coming in and doing a $1.3 million raise, for a $4.5 million property, it's a little bit different. So at the end of the day, that 5% of when you multiply it out of $12 million project is a pretty good start.
Sure. Yes, it is.
Builds that track record, like you said.
Yes.
Yeah, that's like that thing I always say, the quote I always say about 50% of a great deal is better than 100% of no deal. So the same way, 5% of a great deal is still better than 100% of no deal. And so I think that's fantastic. Anybody who's looking to get started, just take that to heart right there. Just the idea of just work with somebody else who's doing it, who's been successful. Honestly, even if you work with somebody and made no money on the deal, at least you're developing a track record. I'm not saying you should necessarily work for free, but it's better than nothing if you're just struggling to get started. So I think that's fantastic. Can I ask you about, before we move on to what happened next in your business, looking back at the first 10 years or 8 years or whatever, it took 10 years to get up to that kind of point. If you were to go back and do that again, that whole decade again, what would you do differently in your life?
That's an excellent question. Because I think, all the learning in those 10 years, I got to learn more from my clients, and those are some of those ex-clients turned into my investors. I think if I had to do it differently, I would have done multifamily sooner, because I think from a scalability perspective, income perspective, all those things, all the metrics. I think most people that I run circles with, are in that single family or wholesaling world, and that's a job. You're constantly looking for that next opportunity versus a multifamily. You're creating that, existing income stream or passive income stream. So to answer your question, I guess would be, I wish I would have had that aha moment sooner, and probably would have, my portfolio would hopefully be a lot bigger now. So, but I'm fortunate for all the experiences that I've, in the pathway that I've traveled. I think it's helped me, to be better educated, dot the I's and cross the T's, and understand this business more. So I think I'm fortunate for the past 10 years to, from a learning perspective.
Yeah.
Hey, so really quickly, I want to just jump back to that property, and then we'll kind of move forward. Now, you're not managing this property, correct? I'm assuming the property is obviously has in-house management. So, I mean, really, at the end of the day, you're just an investor in this deal. You put it together, and now you're kind of part of the portfolio. It's part of the portfolio, right? You're very passive.
Yeah, in that particular 276 unit deal, that is correct. And all my assets, Josh, to be clear, I put that with a third party management company. And I just want to come back to one thing real quickly is, being part of a deal doesn't mean that you have to be a passive, I brought value, I brought equity. But what I did, I just asked a bunch of questions to those that were running the show, like, what about this? What about that? I was just picking their brain. And I think anyone that's listening, that's really important is, even if you don't get a deal across the finish line, take that opportunity to ask as many questions as you can, because it's going to help you. It's going to, because each deal is unique. Each deal has challenge. Each deal is going to fall apart in some cases. So you want to, you've got to be prepared for, the worst situations.
Right on. Okay, 276 units. Fantastic. Then what? What are we jumping to? 500, 1,000, 10,000? Come on. I mean, you went from 2 to 276.
Yeah.
If we're using that math, we're going to a big one next.
Yeah. So what happened next? And this is where all the challenge comes, right? So at the end of, we bought that asset in 2010. We flipped it. So coming now into the end of 2011, I'm still working the CPA gig, and I realized, again, my passion, going back to that junior year in high school, my passion's been accounting. I'm a pretty good CPA, but my passion started shifting. I got to see the real estate stuff start to happen. My clients were making it. I figured, what the heck, I can start this. So again, I mapped out a plan. This wasn't something that overnight I said, I'm going to quit my CPA job. But I ended up quitting my CPA job at a top 100 law firm in the world, and to pursue my own real estate business. So December 15th, 2011, I went to my boss and said, I'm done. And fortunately, my wife is very supportive. And again, we mapped out a plan. 2012 was a very challenging year. I did not buy any multifamily. I had a 98-unit deal that folded. So I had some revelations about myself in 2012, and then in 2013 I bought with partners a 144-unit deal for $10.3 million, and then in 2014 I bought a 209-unit deal for $6 million that appraised at $7.4 million on day of purchase. And when we're recording this in 2015, I'm actively looking for 100 to 400-unit deals up to a $15 million purchase price.
Wow, that's awesome. I love that progression. I mean, I want to touch on a couple of things there. First of all, you mentioned you had you and your wife developed a plan to quit your job. Let's talk about that. I mean, what is that? A lot of people listen to our show. I do a webinar every week here on BiggerPockets, right? And in that webinar, when people sign up for it, they get a link to a survey. And in the survey, I ask them just some more information about themselves, about what are you interested in, et cetera. And one of the questions I ask is, on a scale of 1 to 5, 1 being not at all and 5 being yes, do you want to quit your job? And our average rating is like a 4, right on a 4. So 80% of our people generally, or at least like the majority of people, are very interested in quitting their job. And as a side note, if people want to sign up for a webinar, biggerpockets.com/webinar. But so how do they do that? How do they develop that plan that you did and get to that point?
Sure. Well, I want to point out I'm not unique. What I did was I figured out that instead of going after that shiny object syndrome, I think I do it still myself. We're all over the place. I really wanted to, I drilled down. I had an unbelievable amount of clarity and focus, and it all comes back to my why. Okay, why do I want to go down this pathway? I could have stayed in my CPA gig, still made the income that I was making. I was pretty good at it. I had, clients that liked me, all that good stuff, but the passion, the fire, the whatever else had shifted over to the real estate. So then I mapped out, okay, what if I quit, how much money do I need to make on a monthly basis? Okay, I know that amount. Okay, how many units do I need to buy? Where are those units located? What does that asset look like? Is it in my own backyard, or is it in a different state? How am I going to manage it? Where is the money going to come from? So, it was a very methodical, and that's, I'm a CPA, so I'm black and white. There's not much, gray there. So, there is a system or a process, a checklist, I guess, I put together. It's okay, so very methodically, let's go down this pathway and get it figured out. And so your listeners know that, this just wasn't a one-time thing. I've again had many swings in the cage. I've hit some singles, hit some home runs, and struck out. So know that to move your business forward, you got to take risks, and we can all sit back and just think about or do the education and all that good stuff. We actually got to get out there and take some action.
Yeah, I love it.
Hey, Brian. So. You mentioned, and I think I got the list written down as you were talking, but in 2012, you had the 98 unit that folded. What does that mean? How did that deal just not work out? Tell us about it.
Yeah, sure thing. That was in North Carolina, and that was a deal that I was going to sponsor myself. And just so the listeners know what that means is, as a loan sponsor, the banks basically require a couple of different things. One, you have to have the experience to buy a multifamily deal. If you just bought a duplex, they're not going to give you a loan on a 98 unit deal. You have to have some track record. So I was able to again use the 2010 experience as, hey, this is what I've done. Also, as a loan sponsor, you need the net worth to cover the loan. You also need liquidity. Most lenders, when you close, will want some type of liquidity. Usually it's 10% of the loan balance that you have to have liquidity. In my situation, why the 98 unit deal didn't fold, or why it folded, was I had some private capital that I had lined up, a big investor that was going to fund the whole asset. And he pulled out, a couple of weeks before my money was going to go hard. And that really means, for due diligence purposes, you put up a deposit. You've got many days, could be 30 days, 45 days to do due diligence, to, look at the numbers and do physical assessments and things of that nature. And then if your money goes past that date, it goes hard or non-refundable. So my money, I realized that my large investor was pulling out. So I had to terminate the project. So, I got my money back from the down money, but I also lost money. I lost money because I had to pay to get a third-party appraisal. I had to pay money to get that physical inspection. I had attorney costs. So, suggestion to your listeners is before you get to that far of a process, you really want to make sure you got your house in order, the nuts and bolts.
How do you avoid somebody pulling out?
Yeah, I was going to ask the same question.
Yeah, I mean, because that seems like, it seems like it could be pretty risky. You got guys who have cash who are like, yeah, I got this, I got your back. And, you move forward on assumptions that they're there. Then what? So what do you need to do to protect yourself? What can you do?
Sure thing. A couple different angles I'd like to address that in. First, always make sure you have backup investors. That was a lesson learned. And plus he was the only investor, so he was bringing the full chunk. That's great if you're maybe a seasoned guy, but I was just kind of getting started. So he was 100%. He had more control of the deal than I did. He was the one that's more or less calling the shots. So you always want to make sure you've got what I call my stable A of investors, those that are, have worked with me before, or they've already funded their money. It's a different when someone gives you a commitment and actually fund the money to escrow. So that money was not in escrow. So he never came forward. So again, if investors already got their money in escrow and they want it back, well, that's a different conversation. That's probably maybe a legal question. I don't want to go there right now. But let's say you've got that investor who has not funded, but have said, hey, I want to invest, X amount in your deal. And then all of a sudden they pull out. We want to make sure you've got, team A and team B. So when team A player pulls out, you've got somebody right behind them. So if you're raising $500,000, $1 million, or $2 million, you always want to double that. And that's my opinion anyway. You just double that amount of commitments. So you've got people backstopping each other.
Yeah, that's a great idea.
That is great. How do we go find these people? Obviously, some of it comes with track record. For you, you're lucky. You've got the CPA business you're going on, but somebody who might have done 1 or 2 deals, bought a 30 unit or something, and now needs to kind of go ahead and find some money partners, what would you suggest to them to do to go out and find? And I'm not talking, the postman who has 10, 20 grand. Obviously, you're talking about big money, accredited investors, stuff like that. So how do people go about finding those people?
Sure. And just to address, you don't need to be a CPA to raise money. Anyone can do this. It's okay. Looking at your circle of influence, it might be folks on BiggerPockets, and we want to be careful there of advertising and things of that nature. But it's all about the relationships, what value you can add to others, and go through your what I call the circle of influence. It could be your family, your friends, your CPA, your business associate, your doctor, attorney, and we're not asking those individuals specifically for money. We're just saying, hey, who do you know? This is my business. This is what I'm trying to accomplish. And those in your true circle of influence, those are going to be the ones that really want to try to help you out. And you say, hey, Josh, Brian, I'm looking for this. I've got a deal. I need to raise money. Who do you know that could be interested in this type of thing? Specifically, I'm not asking you guys for money. I'm just saying, hey, who do you know? Who's in your database that might be a good fit? And it always happens is that you start talking to your family and friends. You tell them about what you're doing, all the great things that you can accomplish, and all of a sudden they're like, dude, why didn't you ask me about this? This sounds awesome. Let me participate. Let me get in this thing. So then again, it's all about using your network, your relationships, and trying to get your business moving forward.
Yeah, I love that. And just to go back and harp on one point you just said there about, maybe it's on BiggerPockets and you have to be careful about advertising. That's, completely right. And the idea that okay, so BiggerPockets obviously has a lot of newbies on there, right? People that are just learning. And so, they go onto the forums and they ask a question like, how do I buy a rental property? And then everyone, kind of helps them out. So there's obviously a lot of answers for new people. So a lot of the experienced guys look at that and they say, well, I don't know what value. I mean, I don't know. I don't have any reason to participate on BP in the forums or by building relationships. I'm not in that. I don't need those answers. But I think what a lot of people don't realize is it's that just answering those questions. You might help one person or 50 people that are going to read it, but you're in front of thousands of people who potentially have money who see you as an influential person. And so the people that are most active on BiggerPockets and that are out there helping and being productive and I'll put that not just on BP, but just in general in the world, right? But specifically for BP, they're the ones that everybody's seen as a person that, hey, maybe I could invest with them someday. There's a lot of people in America who have a lot of money and don't know what to do with it. Yeah. So you got to just be the guy that people want to go to because they see you as a mover and shaker. So anyway, that's just my encouragement to people that are listening to the show right now that maybe have, not sure why they should jump on BP because they're already experienced. Well, that right there is a pretty good reason. So yeah, it's great. Cool. Yeah. Hey, Brian, I don't think there was a question in there for him. Was there? No, not really. Just harping on that. No, I love the plug. That's a great plug. All right, so let's kind of circle back a tiny bit and hammer down a little bit more on the deals. You've got a $10.3 million deal. You've got the $6 million. You're looking for these others. What kind of person? I just want to dig a little deeper into the investors. And I don't think the question I want to ask is what kind of person gives you money, but what kind of money are you raising? Are you raising $25,000 at a time, 50 at a time, 100,000, $250,000, $500,000? What are you raising? What kind of chunks are you typically getting for these raises that you're doing?
Yeah, sure. So now that I have a track record, my minimum is $100,000. So that could be $1 million, $250,000, up to $1 million of the investors that I'm able to tap into. Did that happen back in 2010 or even 2009? No. So I think the audience needs to realize that as your business starts to take, or move forward to get traction, you can increase your minimum investment, but maybe starting out, I would suggest only start at $50,000 because to raise a $2 million for a capital raise, $25,000 is a lot of people that you need to, look through your circle of influence. So kind of having that minimum of 50, and you really need a couple big guys, to help that average out. But again, we want to make sure that we're dotting the I's and crossing the T's. If you're pulling money together, I know there's not an SEC call, but, we want to be careful. We want to do the things the right way and make sure you get good counsel and put in the private placement memorandum, the PPMs, all that good stuff. Make sure you get all that taken care of when you're raising money.
Yeah.
Nice.
I love that. Love that. All right. So let's move on. I want to talk a little bit about, how we kind of know how your business has developed. Now you're looking for the larger apartment buildings. How many have you done total now, like units have you bought and sold or invested in?
Yeah, bought and sold almost 1,000 apartment units, valued over $30 million. I currently control the 144 unit deal in South Carolina, 209 unit deal in Texas. And there's some reasons why, if you want me to go there, if I live in Pennsylvania, why I'm, investing in other states. Or
I would love that.
Okay, yeah.
Yeah.
So I'm in the Northeast, and the opportunity cost to, deploy capital for properties around this area are pretty expensive, where I can go to other markets and buy properties that are a lot cheaper. And also my business is built on job growth and economic growth. So where are those markets across the country that those markets are performing very well? And a very simplistic view here, though, is someone's got a job, they can pay your rent. Texas, in my opinion, is a state that's producing a significant amount of jobs, regardless if it's a blue collar, white collar type of job. It's a great business friendly state. Doesn't have an income tax. It's a very landlord friendly state. It's the center of the country, so it's great for distribution of product for big employers. So how I also look at the model is, okay, what are the trends in the marketplace? Looking at Census Bureau data, job growth, economic growth, other. You can, for example, set up a Google alerts. I do that for all the markets that I target, and daily, weekly, you can get news just coming into your email about what's happening in your marketplace. Yeah. I'm in Pennsylvania. I'm buying deals outside my marketplace. So we want to be an expert, and that's what one question the investors are going to ask. Well, you live in Pennsylvania. What the heck are you investing in a different state? Well, what I just told you is what I do, and everyone's investment model is going to be different. But I target markets that have some type of upswing, and I believe the markets, other markets across the country, everything's cyclical. So,
yeah. Hey, so we talked to a lot of people, and especially for new investors, we always try to tell them, try and invest local, try and stay where you can kind of find opportunity, so you can kind of go by, reach out, and do it. I'd like to think that it's a little bit different when we're talking 100, 200 plus units. I mean, it is, but it isn't, right? I mean, you still want to be able to go and see that, things are being run and managed appropriately. But at the same time, you may not be able to as easily find those opportunities. It's a lot easier to find a duplex within 200 miles than a 200 unit within 200 miles that meets the criteria you're looking for. I love the kind of becoming an expert outside the marketplace. You said job growth. You said stable economy. What other things do people want to look for? Do you have any data sources that you would recommend people use to help better evaluate the markets that they're looking at?
Sure. I'm a frugal CPA, so I love free stuff. Marcus and Millichap, which is a broker, has a lot of great free information on what we call MSAs. So the markets like Dallas or LA, New York, Denver, the big markets. Marcus and Millichap does a great job of analyzing this stuff for us, where construction, job permits, absorption rates, all this good stuff is kind of all put together for us. There's another report I use. It's called Viewpoint. It's IRR.com, I believe. I don't know exactly off the top of my head that link, but I'm sure you guys can, figure that one out. And then there's, CoStar, there's LoopNet, even though that's a free resource as well. And I've never bought an asset off of LoopNet, but there's data, and I'm a data junkie. And I think as you're beginning to go down this pathway of putting a larger multifamily, you got to be the expert, because not only are your investors going to ask you, your loan broker, your management company, everyone's going to be pointing to you and say, okay, how are you going to run the show? And they're going to be looking to you or like the quarterback of the team, to navigate and leverage other people's skill sets to, get your property across the finish line. Either that's, the purchase, rehab, get it, flipped, whatever the exit strategy is.
Okay, so that's great. All right, so let's talk about that exit strategy. The first one, it sounds like that 90, not the 98, but the what was that? The 276 unit. You said you flipped that. So how quickly were you out of that deal?
Well, again, I wasn't the operator. So
Right.
the operator are the ones, and I knew this kind of going in that it was going to be a fast-paced deal because there was so much equity in the opportunity. So I knew, and my investors knew, I'm all transparency, and we got to be, because we have other people's money at risk, and what we don't want to do is lead them on and things don't happen. Any deal can go sideways. But so the operators of that deal, put together a refinance strategy. So there was, value that could be extracted by putting new debt on, and myself and my investors that I brought to the deal, we were all refinanced. So we got our principal back plus a healthy return of that particular deal.
Right.
Okay, cool.
And then what about the other ones? The 144, the 209 unit.
Yeah, so the 144, I still have that deal, and that was a HUD deal. And as a disclaimer, well, I don't know if I'm going to say this in the recording, but I'll say what I was going to say anyway. Is HUD is very challenging to work with. I'll say the good first, and I'll come back to the bad.
I don't think they're going to come hunt you down, man. I think it's a government entity that is kind of a given.
Yeah. So we got awesome financing of that $10.3 million purchase price. We got 90% financing. With that came a 40-year mortgage. It's amortized over 40 years. An interest rate of 4.15%, and it's assumable to the next guy. The downside,
oh my God.
The downside is it's compliance driven. It seems like every other day, week, we've got people coming in to look at our asset. We can only, on this particular loan structure, we can only distribute out cash flow twice a year. With that, there is a formula that we need to follow, and if we don't hit certain benchmarks, we can't distribute out cash flow. Secondly, we have to have a significant portion of capital, set aside. It's called a Capex Reserve. We have to have a significant portion, for roofs. This asset is built in 2004. It's a Class A deal. They want us to have roofs, 20 years, 25 years down the road. We have to have money for that. I'm like, are you kidding me? So again, what I was going to say is, would I do another HUD deal? Probably not, because of just the red tape you have to get through. From one side, it's attractive terms, but there's the other side, the other world.
Interesting. I'd never heard that. So
that's
cool.
crazy. What kind of cash flow is that property doing? What kind of returns are you getting?
Well, we projected out a pref return. That means the investors get a certain yield on their investment first, and then after that, the management where I'm at, we get paid. So we projected out an 8 to 10% cash on cash return. But as I shared, because we didn't meet the formulas, we haven't distributed out cash flow for this particular year just because we didn't meet those thresholds. Okay. So each deal is unique. Each deal has its own exit strategy. That's a long-term hold, because I believe, and I think there's a lot of chatter right now when this is being recorded, is interest rates are going to go up. So this rate, we're locked in for 4.15%. There's probably, this is an institutional type of asset for someone else. So we're going to hold this deal for another 6-7 years. Interest rates most likely are going to be higher than they are now, and hopefully, extract additional value out of this property when we sell it down the road.
Fair
awesome.
enough. Fair enough. Hey, so you had talked about, and sorry, Brandon, I got a lot of questions.
Go ahead.
You had talked about management getting paid after the investors. I had written down earlier, how are you actually getting paid? So I understood on that first property that you guys had refied and you were able to kind of get money out there. But these properties that you're holding on to long term, are you taking cash each month? Obviously, on the HUD, you can only distribute cash twice a year. So that's probably not a monthly cash flow. And because you quit your job. So, the real question is, how are you living? How does somebody quit their job, buy multifamily properties by raising money, and then actually make a living? I think that's probably a question that's on a lot of people's minds.
Sure thing. And just to clarify that just a little bit, so our management company is obviously in the operating expenses. What I meant by managing, I'm the managing member. Right. So just want to make sure that, people didn't think we were paying our investors and then the management company gets paid. They get paid before our investors do. But so how I get paid is when I put these, these deals are long and can be challenging and takes a lot of time. So I put together an acquisition fee structure. So I get paid 3 points of the actual purchase price of putting these large opportunities together. So, $10.3 million, that was 300 plus acquisition fee paid at closing. I had a partner, so we split that. So in that particular deal, that was kind of an upfront fee. And then I share in, the cash flow, the tax depreciation, and back-end profit. There are some opportunities, and just to touch on this, some people put what we call an asset management fee in. So usually it's 1 point that as the quarterback of the team or the managing member, you can take 1% of gross collected rents and get paid on a monthly basis or an annual basis. For the deals that I've done so far, I haven't baked that in, if you will, into my opportunities, because if we get to my 209 unit deal, I'm actually taking 50% of that deal. And I'm not greedy by any means, but this again is a lot of work. So I didn't feel, putting in or including an asset management fee on that particular deal didn't make sense, because I still want to make sure my investors get paid and want to make sure the numbers worked.
Sure. And just for people that are listening to this that aren't sure, everything you're talking about is very, very normal with syndication and with putting together big deals. So like nothing you're doing is like, weird. I mean, because like when I think about if I were to do a partnership on a duplex, I wouldn't typically get an acquisition fee at the beginning. That's just weird, right? For the duplex. But with larger multifamilies, that's very, very, very common, and that's just the way it's done. So, and one of the reasons I want to get to where you are, I mean, it's one of the reasons I wanted you on the show today, right? Because I want to be you. So
yeah. Well, thank you, Brandon, for that compliment. But yeah, you're exactly right, and this is like common practice in this particular segment of multifamily. And most important, it's all about disclosure. So I'm not doing anything that my investors aren't aware of or not included in the private placement memorandum, and we just need to disclose these things, and it's disclosed to the investor, and those investors are supposedly informed investors, and they're making the decision to invest with you. So as long as everyone's on the same page, we're not doing anything that's secretive for the investor.
That's great. Great. How big is your team? Is it just you? I mean, are you alone?
Yeah, you're looking at them right now, and for disclaimer, I've got a virtual assistant that helps me with the administrative and marketing, and again, coming back to that 2010, strategic. It's how can I add value? I do have other people that I work with, but I've been doing this all on my own. And to scale this business, I do need to, bring on more people to handle the acquisitions, the due diligence, the raising money. Because right now I'm doing a lot of that myself, and I'm realizing as I move forward that I need to rely on other really smart people. And I've had a fortunate experience on BiggerPockets. Actually, I made a thread, I put a post out there, and I've been fortunate that people have outreached to me and say, hey, how can I help? Sounds like this is a pretty cool thing. How can I participate? So I'm vetting some people right now to see and I only work with action takers, those that like myself, I had to quit my job and I had a goal, and I'm not wanting to work with those that they're just kicking the tires. I want somebody that's, passionate and loves this stuff just like I do. So,
yeah. What kind of marketing are you doing? I mean, you said you've got a VA who's doing marketing. Why do you need to market if you're just going to buy big multifamily properties?
Yeah. So you guys probably know in sales, it's what ABC, always be closing. Yeah. So in my world, I'm ABM, always be marketing, because you always need to be marketing for really, and I'll break this down pretty simple for you, or in my world, is in real estate, it's deals in dollars. People get so concerned and confused that they got to do all these other things, but you need to have the right deals coming in for your investors, and you need the investors, to close the deal. So if you can play matchmaker, you understand from a marketing perspective, or what your investors are looking for, and you market to that category of investors. They're looking for, a property built X and, looks like this and cash flow and returns. We'll market to that subset of people. Then take that group of people and go market to the brokers, other investors, do direct mail, do those things. And then your business, it just happens faster because you're not trying to swim upstream in both accounts. It just makes it a lot easier. And it took a while for me to figure that out. But now with my marketing, my VA is, I've got a website. I've got, I do direct mail. That's how I found and bought my 209 unit deal on a direct mail piece.
Really?
Yeah. So it's and marketing is just not one funnel. It's multiple funnels. These conversations we're having, it's other investors going to your local RIA. It's just not one size fits all. It's multiple funnels that are open, and you never know when that either deal or investor is going to come from. And you just you need to be proactive.
Yeah,
excellent.
I love it. I'm encouraged that you talk about direct mail worked for that apartment complex, because not a lot of guys, and I don't even like talking about that on the podcast because like that's what I want to do, right? And I don't want everybody and their brother direct mailing apartment owners, right? But I'm encouraged the fact that worked for you and that does work. So very, very cool.
Yes.
All right, good deal. Well, let's move over to the fire round.
It's time for the fire round.
All right, these questions come direct out of the BiggerPockets forums, which people can get to at biggerpockets.com/forums. This is that same thing I mentioned earlier about people jumping in, just being active in that part of the site is a good way to build your reputation. And I know you actually did that. I read through your thread. You have a thread about your story, and it was fascinating. And you just kind of start building your brand MVP. So anyway, I'm going to throw some questions at you here. Josh will too.
I might throw a few.
You might throw a few. Yeah, you know. So I guess how would you answer these if you saw these in the forums? Number one. Somebody said, what are some examples of good deals on 4-unit or 6-unit apartments? Some just came on the market for $130,000 and it's not the best area, but I think they're in pretty good condition. How would you respond to that person?
Well, I guess first disclaimer is that that's too small for me.
Sure.
I would move on because from a scalability, I guess it always comes back to the numbers and making sure that the numbers, kind of match up and that, if there's enough cash flow, because, I want to just come back to something real quickly is if someone's focused on a 4 to 6 unit and maybe again, they live in Pennsylvania and they're looking at another state, North Carolina, it's producing $600 or $800 a month. And each month they have to go travel down there or, there's travel expenses. And at the end of the day, this is a lot of work. So I want to make sure everyone knows that this is not one morning I just hit the easy button and all these, cash flow and acquisition fees came flying out. There's a lot of work. So I think getting very clear again on your why. Does a 6 or 8 unit, that get you started? And I'm encouraging anyone that you got to take action to get started. But does that fit the model of where that investor is heading in the direction? I hope I'm answering your question for you.
Yeah, I actually like that a lot because I just get a lot of people. I love your answer there about the numbers. I get a lot of people who email me and say, "Brandon, I found a 4-plex for $150,000. Should I buy it?" First of all, I don't even have time to answer to a lot of those emails, but. I mean,
whoa, are you? Wow.
No, I try to answer every email I get.
Brandon, I'm too busy to answer your emails. That's why I pay you, buddy boy. No,
yeah. No, but here's the problem, right? That tells me nothing. Does $150,000 for a 4-plex? Does that tell me anything?
You need more information.
Yeah,
I think that's one of the big problems that a lot of new people have is, and I was going to go there is when you post, guys. Post some details because that doesn't tell us anything. What are the rents? What are the expenses? You need to, if you want help in getting answers on if something is a decent deal or if other people think something is a decent deal, you need to give some details. And if you're not thinking about those details, then you're not ready to buy that or any other deal.
Yeah.
So. And if I could go there real quickly is I'm a big fan of Stephen Covey, have the end in mind. So if someone's asking you those questions, it's okay. Turn it around and say, well, why is that a good deal for you? Does that fit what you're looking for?
Yep.
Because a lot of people struggle. They want somebody else to answer that question. Why is it a good deal for you? Why is it a good deal for your investors? And if you don't have answers to those 2 questions, you shouldn't be in real estate or you shouldn't be doing that deal or you need to learn a little bit more.
Yep. It's just like that, the Alice in Wonderland, the cat and the cat and the Cheshire Cat, right? And Alice says which way do I go? And he says, well, where do you want to go? And she's like, well, I don't really care. And he says, well, it doesn't matter then, right? If you don't have that predefined, does it fit your goal? Does it fit your plan? I have no idea if a 4-plex is good for you. And so one thing I will say too, just to encourage people, if you're somebody who wants to go and email somebody and ask them about a deal, whether it's me, Josh, Brian here, or anybody in the world.
Don't email me.
Yeah, well, I was going to say, you put it in the forums instead. I mean, because we get certain things, but when you put it in the forums with thousands of people that could see it, you're going to get advice from a lot of different perspectives and get advice from a lot of people that can then jump in and help you in a way that any of us 3 or anybody that you talk to on one-on-one won't be able to do. So that's my encouragement. Point. Yeah. People jump in there and post your stuff if you have questions.
I always tell people to do that, by the way. But they'll hit me up. Hey, I've got a question. I want to know this. I would love to help you. Yeah. Post it on the forums. So you'll get other answers because mine may not necessarily be the right answer. Yep. And B, so that you can get multiple feedback, multiple opinions,
and help other people in the future.
And other people can read it and learn as well. Yep. So All right, cool. This fire round is really going quite Yeah, quite
It's
slow.
a slow burn, Josh.
Yes,
Slow
it
burn.
is. It is a slow burn. Yeah, there you go. All right. Second question is apartment demand and development is surging in some markets, including Texas. What would be your criteria for developing multifamily?
Well, again, I hate to take the sideway here. I don't do development, so
Sure.
I target those assets that are already built. My model is built on value add, those properties that where we can come in and force valuation by either decreasing expenses, increasing rents, doing some type of rehab. So my track record, I don't know how to answer that one from a development perspective, like building the asset out of ground.
And I think your answer was actually really good in that, like, that's not your niche, right? You're not distracted by the shiny object of development just because it might be hot in one market. You're good at multifamily value-add apartment investing.
Right.
So I love that.
You're very wise, Brandon.
Thank you. I'm a wise guy. That's what they keep saying. All right. Number 3, what would be a good job, like a career, to try and work for, to learn about buying and selling city apartments? Like basically, like how do I get a job in that industry to learn more?
I think being an acquisition manager is a good start if that is your skill set. Of course, if you understand the numbers, or being a networker, being a marketer, because it all comes down to really finding the deals and finding that investor. And if you can add the most value by bringing someone a kick butt deal, or you're able to find money and bring that to someone's deal, you're going to be well sought out. So if someone came to me and said, "Hey, I got this deal, or I've got this money," and well, why wouldn't I want to partner with someone? So I think that the best job would be to again either being an acquisition person to understand the numbers and how to put the deal together, or being like a master networker.
That's great.
Yeah, I love that.
Right on.
Just to add on to that, because this is a slow fire round today. So I'm listening to on Audible. I'm listening to the book 80/20 Sales and Marketing by a guy named Perry Marshall. And in that book, there's this long discussion on the idea that most of what a person does doesn't produce the results. Right? 80/20, which says 20% of what you do produces 80% of your income. So
it's Pareto principle, isn't it?
Yeah. It's the Pareto summary, or that whole thing. It was in the 4-hour work week. It's in Pareto. Yeah, all that good stuff. So the idea that So what he was talking about in there is his argument in the book, which I agree with, is whatever you're doing in life, look at what 20% that makes you the most money, and then hire someone to do the other 80%. So I'm going to twist that around to that job question or whatever and say, if you can find somebody like Brian or like the thousands of other guys that are out there doing what you want to do their 80% that they don't want to do that's not making the money, let them do their 20%, and you will make them way more money because you're taking that load off of them. And so if you can find a guy like Brian and do that 80%, like the marketing, like you said.
Yeah, Brandon, that's gold right there, what you just said.
That was gold.
Yeah, that was awesome. That's it.
Thanks.
Yep.
I'm a wise guy.
Oh, wow, man. What you eat your spinach this morning? What's going on here, buddy?
Yeah.
All right. What are your minimum cash flow requirements for buying multifamily, and why? Do you have minimum cash flow requirements?
I do. So minimum for me is at least $5,000 a month, and not including the acquisition fee.
Okay.
So I want to make sure my investors, investors need to get paid first. We have a fiduciary responsibility. But, from where I see my business going, I want to scale in the next, 10 years to control $250 million, and I want $100,000 of passive income come in on a monthly basis. And it's a very strategic, I could go out tomorrow and probably buy a deal, but it doesn't fit. The deals right now is very competitive. There's a lot of, assets that are trading at ridiculous pricing. So we really need to be careful, understand our numbers. But $5,000 a month on a deal is where I need to be on a minimum basis.
Gotcha. And by the way, you helping tens of thousands of investors get better at this is not going to help this competitiveness. So, just so you know.
Yep. So I better stop while I'm ahead, but...
Yeah. Oh, sorry. I'm not going to answer that question, Brandon.
Yeah. All right. Next question. Let's see. I think we kind of covered that one, but I'll say it anyway. When looking for a multifamily property, what do you look for?
Yeah, so it comes back to, once I understand I've got a pool of investors that are looking for the deal, and then I go out shopping basically for them. So again, I'm a value add guy. So I got to be buying a property, and I'll use my 209 unit deal as an example. I bought that through a direct mail, and direct mail didn't happen just on one letter campaign. I think that's where people get a little bit frustrated. They do one result, they get a 0 response rate, and they say, this stinks, I'm done. In my model, it's a very consistent approach, 3, 5, 7 step letters to that, owner and I'm very targeted on what type of property I'm going after. So for me, I'm looking for something where I can fix up, increase the rents, decrease the expenses. I bought that 209 unit deal for $6 million. On the day of purchase, it appraised at $7.4 million. And I've been able, since ownership, I bought that a year ago. So I've been able to increase rents $100 per unit. I've spent my Capex budget is $750,000. I've spent $500,000 so far for doing exteriors, painting, interior upgrades such as switching out the lighting, the carpet, just adding more of that little curb appeal to force value, because we haven't really covered how multifamily is valued, but it's all on the net operating income or the NOI. So we want to be, drastically pushing that NOI. So that's going to help our valuation when we either sell or refinance.
And since you opened the door, let's keep the slow burn going really quickly. What is NOI? How does somebody figure that out?
Yeah, so NOI is basically take your gross collected rents and subtract out all your operating expenses. What's not included in NOI is your debt service, what you have to pay your bank, your mortgage, the interest. So that gets you down to NOI. And multifamily properties are based from a value basis. It's not based on sales comps. It's based on cap rates, and those cap rates are at the local level. So a cap rate here in Pennsylvania, where I'm at, for a C-class building in a C-class area might be, a 5, 6, 6.5 cap. I go to Texas and that same asset might be an 8 cap, or, in a different market. Texas is pretty competitive too, actually. But so each, market is driven by that local level cap rate, and that's what determines valuation.
Right on. All right. So my last question I'm not going to read because I know you're not actually going to answer it, not because you're a bad guy, but because I know how you answer the questions you want to answer and don't want to answer.
It has nothing. Yeah, you've done it. So
yeah.
I'm not going to deal with it.
So I'll just ask you a quick question. Hypothetically, should I be looking for deals that are on market or off market? Has not been asked, or I'm sure it's been asked 100 times on the forums, but that's the final fire round question.
Yeah, so is any market really off market? A broker may tell you that it's off market. I can tell you, for me, my deal in Dallas was off market because I sent the letter directly to the seller. It's a lot of work to actually get letters to the seller, but that's a different topic right now. But so I bought deals that are on market and off market, and I think it all comes down to, what do you want to pay for it? Because a seller's going to tell you, hey, my deal's worth $10 million, and if the numbers only check out at $8 million, that's your offer, or your strike price should actually be $7 million, and then you work up to that $8 million. So I think it really comes back to take the emotion out of this. And if the deal's on market or off market, as long as it fits the investment parameters that you and your investors need to hit, and you can make the thing work, and you have a strategy of once you buy the property and how you're going to execute the game plan, and then how you're going to execute, getting paid at the end of the day, because that's what you and your investors are all striving for, either that sale or refinance, and cash flows along the way. So I'm open to any deal as long as it fits in my investment criteria.
That's great.
Perfect.
Fantastic.
All right, moving on to the world famous for. We ask these questions to every guest, and so we're going to throw them at you right now.
Sure
Number
thing.
1, what is your favorite real estate related book?
Can I name more than one, or is it am I limited to
Go
one?
for it.
I'll allow it this time.
Okay. So I think one, again, I focus on markets across the country, and Dave Lindahl has a book called Emerging Real Estate Markets. And since I also raise money through a syndication, there's a guy named Gene Trowbridge that has a book. It's a whole new business. And how I raise some of my money, about 30% of my money, comes through self-directed IRAs. So there's a guy, he's not as well known as some of these other ones. Joe Luby has a book. It's Keep It, Advanced Tax Strategies for IRAs. So how, investors that want to use IRAs to invest in real estate, how you can participate in these types of deals.
Fantastic.
Yeah.
All right. Cool. Favorite business book or books?
I got a couple of those as well. As someone that is just starting your own business, there's a lot of moving targets, and for me, I need to really focus on Getting Things Done by David Allen. Was a benefit for myself. The E-Myth Revisited by Michael Gerber. Think and Grow Rich. I think any entrepreneur or business owner should consider reading Napoleon Hill's book. I'm a big diehard Tony Robbins guy. So when I put this plan back together, and I flew to Fiji, I was with Tony Robbins at his business mastery course, and Tony's got a great program throughout. If it's just not business, it's got some other programs. So he's got a business mastery course. I'm a big marketing guy. So Dan Kennedy's got a book because I'm targeting that affluent, investors that can invest 100K. He's got a book called No BS Marketing to the Affluent. And I'm still bad at this, but there's a lady, Julie Morgenstern. She's got a book, Never Check Email in the Morning, because when you wake up in the morning, there's things that you should be doing, getting those top 3 priority things done, and email can distract you. So,
I love it. I just added like 5 books to my list on Amazon. So I'm gonna. All right, cool. Josh,
what about hobbies? What do you do for fun? You got two little girls. What do you guys like to do?
Yeah, we like to travel. Actually, next week we're heading to Arizona to do some family time. At the end of August, we're heading to the Outer Banks. We enjoy our time traveling. And the type of business I'm in, I basically, because my properties are across the country, I can work basically remotely or virtually. I like to golf, even though I'm not as good as I'd like to be. But I do enjoy getting out swinging and working out and just enjoying this business. To me, I think. When I was a CPA and that grind, that was work to me. Now I'm in my passion state. So this is fun. I love putting deals together, talking with people, these conversations we're having. I get, that thrill. So that's kind of my, kind of hobby because I love the business.
Outstanding.
Yeah, I love that. Cool. All right, my final question of the day. What do you believe sets apart successful real estate investors from those who give up, fail, or never get started?
I think it's a simple answer of the why. Understanding what you want in your life, what you want to happen, how much money you need to make, and taking action towards those. And those actions, if like I said earlier, I need a minimum of $5K a month. Well, some people are like, wow, that's a lot, or that maybe that's not enough. But anyway, what would be 3 action steps, to get towards that goal? And then maybe they're the baby steps. I mean, think of our social security number. It's 3 parts. Think of our name, first, middle, last name. It's 3 parts. Chunk this thing down into small parts, and then each day, each week, each month, take actionable steps to that big goal. And then, at the end of the day, we can all read as many books as we want. But as I said before, you got to get in the cage. You got to take swings. You got to take risk. Surround yourself with the people that you want to be, that's doing those things that you're doing. Just, surround yourself and get in that same circle of influence as them.
Brian, you and I should go golfing someday. I need to surround myself with.
I want to bring a video camera to that.
I'm such a terrible golfer. Anyway.
I can't wait to see it. All right, Brian, before we let you go, is there where can people find you? Obviously, you're on BiggerPockets. You have a website. Share away.
Sure thing. So my website is Adams, ADAMS, investorgroup.com. And, this community that you guys have formed, I put this thread out and there's some really good nuggets in my opinion, on the thread about me quitting my CPA. I forget how it's worded, but go to the multifamily forum and I tried to address as many questions, if not all the questions that people have asked. So I want to, give back as much as I can because this pathway was not easy, but through this I've learned so much. And if I can help some others, get that massive action, get those goals, financial goals, go away. Do you want me to give my personal email or phone number, or
that would be a bad idea?
Okay, all right.
only because you'll get inundated.
Okay, thank you for that. Then I will hold it right there.
Yeah.
Cool. Yeah. And I'll also link to in the show notes. We'll link to that thread of yours in the forum, so people can check that out at biggerpockets.com/show135.
Brian, thanks so much for coming on, man. We really appreciate it, and thanks for being part of our world.
Thank you so much. Appreciate the opportunity.
All right. Thank you, Brian.
Thanks. Take care.
All right, guys. That was Bryan Adams. Big thanks to Brian for sharing just everything. That was outstanding, man. Yeah. I mean, I think newbies and others who've been in the game a little bit are going to just be blown away that they can probably do this stuff too.
Yeah. I love his technique of this idea of, having a plan, basically lining up the dominoes as the one thing talks about, and just knocking that out, because it's his plan. He didn't get distracted by the stuff. He's very single-minded and straightforward in what he's doing, and I just love that. So
yeah, I mean, in the fire round, we were asking him questions from people, and he couldn't answer them, not because he didn't want to, but because he doesn't get distracted. He does what he does. He's focused and he's on it. And I think that's a great way to go ahead, the one thing, right? To go ahead and build out your business. So that's awesome. That's awesome. Well, great. Fantastic show. Yeah, that was a lot of fun. And I'm excited to go buy a few, multi-100 unit buildings.
Yeah, me too. Hey, what we've never really done before on the show, and we should. I'm going to ask you. Well, I'll first say this: if you guys are listening for the interview, you can go at this point. We're done with the show. But I want to ask you a question, Josh. I heard this on another podcast recently. What movies have you been watching lately? We're just going to take this away from real estate. Get fun here for a minute. What movies have you been enjoying lately?
What have I been enjoying lately? Wow.
And or TV shows.
That TV show is probably a better idea.
Okay.
And there's nothing on TV during the summer. Absolutely nothing. We just caught Rookie Blue yesterday, which is pretty. It's one of these shows that we've liked for a long time. I this summer loved Silicon Valley. Totally
I haven't watched it yet.
Oh, you got to see it, man, because it's us. It is literally this show about these just nerdy guys who have built this outstanding company. But you know what? I think this summer, all the shows have this kind of painful attribute. It's like they have these lead characters that you really like and you really want to see succeed, yet they have these weird quirks and they keep screwing things up. And so it's kind of painful and you're cheering. It's like The Last Man on Earth, which was another show that we watched, end of the fall, end of the spring. I don't know. That's kind of what I've been watching. What about you?
Nice. I just I have like 30 minutes left of Daredevil on Netflix.
Is that with that's not Ben Affleck?
Not a Ben
movie.
Affleck. No, this is the TV show Daredevil that Netflix released. It was rated the highest show on all of Netflix. It was like It beat out House of Cards in ratings. Like,
is it good?
I expected it to blow my mind. No, I don't think it's very good at all. I mean, it's fine. Terrible. Like, it's fine, right? It's an okay show.
There goes Netflix as a sponsor.
I know. No, I mean, I think it's fine. I think anybody who says it's better than House of Cards is insane.
That's hard to beat.
It's hard. I mean, like it's a fine show. It reminds me of something that you'd maybe see on like ABC Family. Like is it a drama or is it like a an action? It's very cartoony action hero. It's a comic book show.
Okay.
And they do a good job for a TV show. It's great. It reminds me of a movie. But I don't know. There's so many cheesy things. Maybe I just because I'm not into the comic book thing. I don't know. But it's fine. It's a good show. But I just personally, I'm like, this is nowhere near what I expected it to be. So
yeah. Yeah, well,
you can't win them all. Whatever.
No, yeah, but otherwise, I don't know. I'm not, we're not doing too much of that at night. We've been playing some backgammon. Getting a little gaming happening, which is fun. Do you play backgammon?
I don't even know what backgammon isn't it. You get the board when you get like a chess set. Usually they flip it over and there's a backgammon board. When I was a kid, I got that. Yeah.
Yes, that's what it is. It's one of those prizes that every kid doesn't want to get.
Yeah, I guess. Yeah, I never played it.
It's fun. It's a gambling game actually. There's like a dice.
Teaching kids to gamble. Good job.
There you go. Come on. What kids did not gamble with their grandparents growing up? You played cards. You played War for a quarter. Or that's a terrible game, by the way.
War.
The never-ending.
Yeah, you just flipping cards
ever.
Yeah, we played a lot of that, and then I shifted to Egyptian Rat Race. Ever played that game?
I have not heard of that.
Best card game of all time. You and I, the BP group, should play it sometime when I'm in Denver next. It's absurdly fun.
Nice.
Anyway, yeah,
outstanding, awesome, man. Well, cool. I'm excited for you to leave. I mean,
thanks.
I wish you luck when you go on your journey to where are you going? Disneyland. You're going to the Florida one, the California
one, yeah. And I'm hoping to have dinner at the Pirates of the Caribbean ride. That is my ultimate goal for this trip. That's the only thing I really care about this trip is dinner at Pirates of the Caribbean.
Nice. I will tell you that when we have gone over the past couple of years, my girls are a little bit afraid of the. There's a big drop. I'm going to blow it for everybody who's never been on that ride, but there's a big drop in that ride. And my little kids did not like the big drop. Let's just put it that way.
I'm sorry.
Yeah. I have lots of Disney stories, but I can't share them with the world. There are some fascinating dork and adventure Disney stories.
I look forward to hearing them off air.
Yes. All right, guys.
Let's get out of here.
Well, thanks for listening. Show 135 of the BiggerPockets podcast. Check it out. Well, you've already checked it out if you're in us now. So get out of here. Follow us on Facebook. Jump on BiggerPockets. You experienced guys, jump in and help the newbies and everybody get in there and make it happen. and then get out there and actually make it happen in the real world. So thanks for listening. I'm Josh Dorkin, signing off.
You're listening to BiggerPockets Radio, simplifying real estate for investors large and small. If you're here looking to learn about real estate investing without all the hype, you're in the right place. Be sure to join the millions of others who have benefited from BiggerPockets.com, your home for real estate investing online.
Have I told you that I...
Is that his song?
Bryan Adams?
Yeah.
Yeah.
Okay.
Yeah. All right.